If you have ever seen a screenshot on crypto Twitter where someone turns a few $100s into thousands overnight, you are not alone. It looks unbelievable, right? But it is real, and it is not luck. It is a strategy that more and more traders are using to grow small accounts fast. And later in the video, I will show you how that strategy works, why it is so powerful, and how some traders are using it to make consistent profits with less capital. I will also share a practical method you can use right now to start testing it safely. But before we get to that, let us talk about why this matters. Most traders start with limited funds. They do not have the capital to take large positions or wait through long trends. This strategy gives them an edge. It allows them to use small amounts of capital to trade larger positions and access more profitable setups. A 2% move on a trade might only be a couple of dollars in spot trading. But with this strategy, that same move can produce $20, $50, or even $100 in profit depending on your size and setup. That is how traders grow small accounts quickly without waiting for massive market moves. Now let us look at what makes this approach so effective for smaller accounts. The key advantage is access. With this strategy, a $100 account can take positions typically reserved for traders with far more capital. That means more flexibility, more opportunities, and more meaningful outcomes per trade. You are not limited to one or two setups. You can act on high conviction entries across multiple coins. You can scale positions around structure and take profits more frequently. When managed correctly, the growth potential is very real. This works best when paired with discipline. Now let me show you exactly how it operates. This strategy is called leverage trading. It allows you to borrow buying power from the exchange to increase your position size. To understand how this differs from spot trading, here is a quick comparison. In spot, $100 gives you $100 worth of crypto. You own it, and your risk is capped at your input. But with leverage, your $100 might give you access to 500, 1,000, or more. You are borrowing the rest from the exchange. This means small price movements can deliver outsized returns. A 10% gain on a 5x leverage trade means a 50% return on your capital. But the same is true in reverse. A 10% drop results in liquidation, and your capital is lost. The more leverage you use, the less room for error. At 10x, a 10% move against you wipes you out. At 50x, just 2% is enough. That is why timing and structure are everything. Leverage is not for every trade, but there are moments where it makes perfect sense. When the market is moving clearly, volatility is high, and your setup has defined risk. Leverage can give you more from the same amount of effort. It turns strong ideas into strong results. It is most effective when you know exactly where to enter, where to exit, and what invalidates your trade. It also lets you act on more trades without needing a huge bankroll. Instead of committing all your funds to one position, you can distribute risk across multiple trades with tighter control. That gives you more data, more practice, and more opportunity without overexposing your capital. But this only works if you are selective. Leverage should not be used on every setup. It should be used when the conditions are clear, the plan is defined, and the trade is worth scaling. Not every coin is suitable for this strategy. Some move too slowly and tie up your capital. Others move erratically without structure. For example, a coin like XRP may take days to move 10%. That makes it less attractive for short-term trades. On the other hand, coins like Bonk often move 8 to 15% in a single day. These are ideal for clean, quick setups. You also need to pay attention to the broader market. Altcoins often move in reaction to Bitcoin. If Bitcoin is moving in the opposite direction, your trade may fail regardless of what the individual chart shows. The best candidates are high-volume coins with strong liquidity and consistent movement. Once you find the right asset, your time frame becomes the next factor to manage. This strategy is not built for holding trades over long periods. Even if the price stays flat, your trade can slowly lose money due to built-in costs. Some exchanges charge a small fee every few hours, just for keeping your trade open. This is called a funding fee. It helps keep the price of your trade aligned with the real market. Other platforms charge interest when you borrow money to trade with more size. This is called margin interest or a borrow fee. You are paying to use extra buying power. And on top of that, every time you open or close a trade, you pay a small transaction fee. Over time, these costs add up. That is why experienced traders keep their trades short. They use fast-moving charts like 5-minute, 15-minute, or 30-minute time frames. Their trades last minutes or hours, not days. This helps them stay ahead of costs and react quickly to price changes. A 2% move with 10x size becomes a 20% gain when managed well. But even strong trades fall apart without control. Let me show you where most people get it wrong. Most traders misuse leverage because they treat it like a shortcut. They enter large positions with no stop loss. They chase moves, hold losers, and ignore key metrics like liquidity, fees, and funding. It only takes one wrong candle to wipe out a poorly planned trade. This is not about luck. It is about lack of structure. Leverage does not forgive mistakes. It multiplies them. The traders who survive are the ones who plan every entry, control their size, and never trade without an exit. Now let us look at how to do it the right way. Start with 2x or 3x leverage while you build consistency. Set stop losses before entering trades. Use assets with high liquidity and clear price action. Stick to short time frames. Take small profits consistently. Avoid holding through uncertainty. This is not about chasing one big win. It is about making calculated moves with controlled risk. When you focus on setups you can repeat, growth becomes a result of practice, not luck. Now let us look at a simple, effective strategy that applies everything you just learned. Range scalping is one method that works especially well in sideways markets. First, pick a volatile coin with active price movement. Use a 30-minute chart to mark clear support and resistance levels. When price reaches one of these zones, enter with low leverage and aim for a 5 to 10% move back toward the opposite side of the range. Place a stop just outside the zone. You are not trying to catch the full move, just the part with the highest probability. Exit cleanly, reset, and look for the next opportunity. This strategy works because it is repeatable. It minimizes risk and maximizes opportunity. But for it to work long-term, your position sizing must match your reward model. Every trade should be built around a clear risk to reward ratio. If you risk $10 to make 30, that is a 1 to 3 setup. With 3 times leverage, your position is larger and the gains are amplified, but so are the mistakes. If you hesitate to exit or widen your stop, your edge disappears. Winning trades stop being profitable. Losing trades become destructive. Discipline is what separates long-term success from short-term luck. Cut losers fast. Let winners hit their target. Never trade without a plan. But even that will not be enough if you lose focus under pressure. Leverage does more than affect your position size. It changes your mindset. Every small move feels larger. You begin reacting instead of following your plan. This is where most traders fail. Not because they lack skill, but because they let emotion override structure. To win with leverage, you need mental clarity. You need to follow your rules, not your feelings. The best traders are not impulsive. They are consistent. They act with purpose, not emotion. If you cannot stay composed under stress, leverage will expose that quickly. Leverage trading is not something to imitate from a screenshot. It is not a fast track to riches. It is a professional tool that demands control. Start with small trades, practice on demo accounts, track your outcomes, review your decisions, build habits. The traders who last are the ones who improve quietly over time. They do not need to impress anyone. They just need to stay in the game. Leverage can accelerate your progress, but it can also accelerate your mistakes. Used with structure, it multiplies your edge. Used with emotion, it ends your journey early. Start small, trade smart, stay focused. And remember, surviving the market is already a win. If this helped, subscribe for more, and I will see you in the next one.